Stop whatever you're doing and look at what just happened in silver. If you have a bank account, a pension, or any kind of savings, this concerns you. Silver did not have a normal pullback. It ran up toward $93 an ounce, and right at that point, the White House stepped in. They delayed new tariffs on critical minerals, sold it to the public as help with inflation, and to the market as a reason for prices to cool down. For a few minutes, it seemed to work. The headline hit, algorithms sold, and silver dropped about $7 almost instantly. Then the selling stopped. Buyers came back in. A move that used to break a rally barely left a mark. As silver moves toward $100 an ounce, officials are running out of ways to keep it under control, and the tools they have left can hit the price hard in the middle of the night while you are asleep. To understand why those tools no longer work the way they used to, you have to compare this market with the last great silver spike. In 2011, when silver ran up to around 49 and then collapsed into the low 30s, the people buying were mostly speculators, retail traders on margin, and hedge funds using borrowed money, players who could be pushed out by a change in the rules. The exchange raised margin requirements, the price turned, margin calls kicked in, and a wall of forced selling crushed the rally. Today, the buyers on the other side of the screen look very different. Sitting on the bid, you now have companies like Samsung securing silver for solid-state batteries, the global solar industry taking a large slice of annual supply, and electric vehicle makers like Tesla and BYD that cannot ship cars without silver in their components. These are not gamblers playing with leverage. They are large industrial firms defending their production lines. So when the president delays tariffs and the paper price drops $7, a different pattern appears. Samsung does not get a margin call. Solar manufacturers do not dump inventory because of a headline. They see a lower price for something their factories must have, and they buy more. They pay with cash, they take metal off the market, and they turn a policy move into a buying opportunity. You can scare a speculator with a press conference. You cannot scare a factory that needs silver to keep running. That steady industrial demand is now the floor under every sharp sell-off, and that is the part the banks did not fully account for. When I asked this community whether the authorities would try to change the rules again before silver reached $100, most of you said yes. You did not know the next move would involve the president, but you understood that no one was going to allow silver to move into triple digits without a serious effort to stop it. You are right to be wary, because $100 is not just another price. It is the level where mainstream financial media has to talk about it, where television anchors are forced to ask what is going on, and where people who never think about metals suddenly start paying attention. For banks and for governments that are trying to manage the public view of inflation, that is a problem. If ordinary savers start buying physical silver in response, the balance between paper claims and real metal starts to shift. The tariff delay was meant to be the first line of defense, something that would reset the chart and calm the mood. It failed. The market absorbed it, and the trend survived. That brings us to a harder question. If a direct move from the White House no longer controls the price of silver, what is still available in the background machinery of the market? The truth is that you have already seen the first two tools. One is straightforward margin increases. The other is using major announcements and policy headlines to push the market in a desired direction. Both have been tried. Both have lost power. What remains is a smaller group of rule changes buried inside the exchange and the regulators, tools that all follow the same idea. If you cannot stop people buying, you change the conditions under which they are allowed to buy. That is what I call the final playbook. It starts with one simple move that sounds technical but has very real consequences for anyone who is long silver. Emergency position limits, where the exchange suddenly declares that no one is allowed to hold more than a set number of silver contracts at once. On the surface, emergency position limits will be sold as a way to stop manipulation and protect the market. In reality, the goal is to force big funds and concentrated long players to cut their positions so that selling pressure breaks the rise in price. The problem for the people pulling that lever is that position caps only touch paper. The real anchor for this market now is the group of industrial buyers holding and accumulating physical metal, not a hedge fund with a screen full of futures. You can tell a trader he owns too many contracts. You cannot tell a factory that it owns too many bars in its warehouse. That brings us to the second move, cash settlement only. If the exchange is caught in a tight supply situation, it can declare there is not enough metal to deliver and close out contracts by paying dollars instead of handing over silver. Longs wake up to find money in their account and no claim on metal. It will be presented as an emergency step to keep the system stable. We have seen this kind of rule change before. In 1980, when the Hunt brothers tried to corner silver, the exchange raised margins, restricted new buying, turned the market into liquidation only, and the price collapsed. It worked in the moment, but it also showed everyone that the rule book can be changed when big players are in trouble. That is why you should treat these tools as standard responses, not wild theories. They are what officials reach for when a commodity price starts sending a message they do not like. The problem is that this kind of solution does not work for people who actually use silver. The factory cannot run on dollar bills. If an industrial buyer is given cash instead of metal, it will simply take that money and try to buy physical silver somewhere else, very likely in places like Shanghai. At that point, the price on a Western exchange can start to drift away from what real metal costs in the physical market. And once that gap opens up, it becomes obvious and the loss of trust is very hard to repair. The third move is more direct. It is a trading halt and the cancellation of trades. We have already seen what that looks like. In 2022, when nickel prices exploded on the London Metal Exchange, trading was stopped and billions of dollars of transactions were simply canceled. If silver looks ready to go through 100 in a full squeeze, regulators could try the same thing, stop trading, freeze the screens, and undo any trades they think move too far, too fast. That is the only step that can really stop the price on your platform in an instant. But closing a Western exchange does not stop people needing silver. If New York is shut, Shanghai does not close just because of that. Trading and price discovery do not disappear. They move. Turn off the American market and you hand more control. Overpricing to Asia. The gap between a frozen Western quote and a live Eastern market will grow, and with it goes Western control of the story. For many years, New York and London have been treated as the main scoreboard for commodity prices. If a halt or a cash settlement order pushes more real trading to Shanghai, that order starts to change. Imagine being an industrial buyer in Asia, looking at Western prices stuck at 90 while offers in Shanghai are already at 105. You are going to trust the place where you can actually get metal. Once people see that kind of split, they stop asking what silver costs and start asking which market is still honest. That question does not stop at silver. It spreads into energy, food, and eventually into currencies. If Western exchanges lose control of the main reference price in silver, the issue is not just one metal, it is who sets the terms of financial reality. That is, the real corner policymakers are in. They can pressure traders and funds, but every time they use one of these last resort tools, they push more physical buying and more honest price discovery into other markets. At this point, you might be wondering why they do not simply keep sitting on the price with paper, using these methods for as long as it takes. The reason is that there is a piece of options math working against them. It is called gamma. There are now large piles of call options stacked around the $100 level. Months ago, banks and dealers were willing to sell those calls because they thought $100 silver would never arrive. Now that the tariff move has failed, the option sellers are back in the same problem zone. As the spot price edges toward $100, the banks and dealers who sold large stacks of call options at that level are pushed by basic options math to buy futures to protect themselves. The nearer the price gets to 100, the more they are forced to buy. And that creates a loop where rising prices force more hedging. And more hedging helps push the price higher. The tariff delay was an attempt to knock silver back toward 80, let those options expire without drama, and release that pressure. The rebound in price kept those contracts alive, so the pressure is still there. While officials are busy with press releases, the real world of metal is telling a different story. Big retailers are putting limits on how many silver coins a customer can buy and still selling out. Mints are running on back order, and dealers are talking about weeks before they can deliver. A president can sign a paper that delays a tariff, but he cannot sign one that creates new silver in the ground. Central banks can create more currency. They cannot create more ore. A headline can move a paper price for a day. It does not change how many ounces sit in vaults and warehouses. That is why the shortage is rooted in the physical world, while most of the noise lives in politics and trading screens. There is another part of this most people miss, and it sits in the mining sector. When the tariff headline hit and silver dropped intraday, mining. Shares were sold down by trading algorithms that only saw a lower metal price. On the surface, that reaction looks tidy, but underneath it makes very little sense. At around $93 silver, many primary miners and byproduct producers are making very strong cash flow. Their costs were set years ago at much lower prices, so a large part of the recent rise in silver flows straight into profit. Yet the market still values many of these companies as if silver belonged back in the 40s. Earnings have moved up with the metal, share prices have not. That gap between scary headlines and strong business results is like a spring held under tension. When quarterly results force investors to face that difference, the adjustment in price is unlikely to be gentle. Put together, this is where the system stands now. Margin increases have been used. Political intervention through tariffs has been used. Both have lost their impact. Silver sits close to $100 an ounce. The pressure from those options is still there. An active market in Asia gives buyers a place to turn if Western exchanges interfere. Industrial users are treating every pullback as a chance to buy the metal they need. Banks, regulators, and policymakers can feel that they have less room to move. To see how little room is left, it helps to think about who is on each side of this rise in price. On one side are miners and royalty firms whose costs were set in an older price world and whose sales are now marked in a higher one. Each extra dollar in the silver price drops into their income. Their main problem is not making money, it is persuading a cautious market to revalue that income. On another side are industrial users. Each rise in silver eats into their margins unless they pass the cost through to customers. That means higher prices for solar panels, electronics, and many other goods. Their choices are all difficult. They can eat the cost, raise prices and risk losing business, or redesign products to use less silver and hope it does not damage performance. Banks and brokers sit between these groups. They have exposure to both mining and industry on their books. A badly structured options book or a short position that moves against them can turn a stable business into a sudden loss. At the same time, they earn money from activity and volatility. They want trading, but not a one-way move that hits their own positions. And then there is you, the saver, watching from the outside. If you do not hold metal, silver at 100 is a signal that the money you use is losing purchasing power faster than official figures suggest. If you do hold metal, the same move tells you that your insurance is working, but also that the system you are insuring against is weaker than you were told. All of this gives decision makers a very small window, perhaps a couple of days at most, to try one last large move before silver moves into triple-digit territory and the wider public is forced to notice. They will almost certainly try something again, but whether it works the way it once did is another question. The same forces that absorbed the last intervention are still in place. So what you need to be ready for now is not a gentle market, but a sudden move while you are asleep. If there is going to be one last scare tactic, it is likely to come in the thin hours between 2 and 4 in the morning, when there are fewer orders in the system and prices can move quickly. You may open your screen to see silver several dollars lower. You may see headlines saying the rally is finished or that a bubble has burst. You may feel that familiar knot in your stomach and the urge to sell before it falls further. It is important to understand what the move really is. It is not the end of the trend. It is the last attempt to shake metal and shares out of the hands of people who have held through the rise so that stronger buyers can pick them up at a discount. If you own physical silver, the main point is straightforward. Do not feed that move by rushing your coins and bars back into the market. If you own mining companies, pay attention to what they earn and what it costs them to produce, not to every sharp intraday swing. If you're still watching from the side, notice how each new attempt to push the price down has been shorter and how quickly buyers have come back in. The part of this that makes the situation so unstable is the size of the market itself. The value of all the silver mined in a year is counted in tens of billions of dollars at current prices, which is a large sum for a single company, but very small. Next to the trillions that flow through government debt, large stock indexes, and central bank balance sheets, a single sovereign fund or pension fund could decide to put a modest share of its capital into silver and absorb a meaningful part of annual supply. That gap between the small size of the metal market and the large message it sends about inflation and scarcity is what has made silver a recurring problem for policymakers. It is big enough to send a warning and small enough to move with focused pressure or sudden rule changes. Add that to the fact that factories now depend on it and that trust in financial signals is fragile, and you get an environment where a last attempt to control the story is very tempting. On paper, a new rule, a strong public message, or a brief halt in trading can look like tidy solutions to a minor market. In real life, they risk turning a minor price move into a bright warning flare that people notice across the whole financial system. For the first time in many decades, ordinary savers and industrial users together have some leverage against a structure that once set prices from a screen with little resistance. Remember the sequence you have seen. First come the higher margin requirements, then come the public statements and political pressure. When those do not work, the next step is to change the rules themselves. Margin increases, political moves, and rule changes, 3 stages of the same plan, and this time they are meeting a market that is not built like it was in 2011. Most people will only see the headlines and the sharp moves on the chart. You now understand what sits underneath those moves, so pay close attention to what happens in the night session and how quickly any forced drop is bought. When silver finally moves through 100 and the main news outlets act surprised, you will know why it happened and why the attempts to stop it could not hold. If you want to stay with this as it plays out and see how the same methods appear in other markets, subscribe and let me know in the comments what you're seeing in your own metals markets. Thank you for watching, and please subscribe and like the video. Nothing in this documentary is financial advice. Always do your own research and consult a licensed professional before making financial decisions.